Now, every month I do a show that is focused on real estate and real estate investing. As you, my listeners, know, I'm a small business management consultant, but I am also a real estate investment advisor, and I specifically work with people on placing their assets inside of real estate. Today, I am delighted, and I actually sincerely mean I am delighted to have Doug Duncan from Fannie Mae, the Senior Vice President, here with me on the phone on this call. We're pre-recording the show, so just letting you guys know that. And I am excited. We get him for 25 minutes of his time. And hopefully I have some good questions for him for both my real estate investors and maybe a little bit for those of you who are in small business and are affected by Fannie Mae and the ongoing interest rate. The central focus, the central issue, the central importance of what Fannie Mae is up to is that its effect is so widespread across the U.S. economy. And what it's trying to modulate, what it's trying to look at and respond to and actually be interactive with is this very large, almost behemoth database that you're trying to pull together to say, okay, we're going to make this decision. And the decisions can seem very singular, but the effects are multiple. And
it is true. We're about 30% of the total market in terms of the finance portion of the market, which means I think we have somewhere between 15 and 17 million loans in our portfolio. Mm-hmm. So, and they're across all parts of the country, so we can have a feel for what's happening regionally and locally. And, for example, we forecast house prices in 110 different markets just because those are things that matter. But we serve two or three purposes as an organization. As you know, we're in conservatorship. The government invested about $116 or $17 billion into us. We've paid back well more than that, but there will require some legislation for us to be released from conservatorship. But the one thing that we have done is provided liquidity, whether it was for people to refinance their mortgages or take out mortgages, even through the crisis. Mm-hmm. So it was useful to have us there. And what we try to do is make available some of the things that we learned back to consumers and back to investors in information that helps them understand where the markets are today. And, of course, we also offer different product offerings attempting to meet their needs as well. On the social side, I was just going to comment. We recently released and actually will go into production with a mortgage called Home Ready, and that's the characteristics of that loan for the first time allow the borrower who may have other family members other than, say, a husband and wife. Maybe there's grandparents, or maybe there are adult children, or perhaps they just have a boarder who are long-term residents of that property, and they have income. That can also be included in qualifying for the mortgage. That's a change that we've done, and part of it reflects our understanding of demographics, which suggests that going forward, about 3/4 of the household formation in the United States is going to be racial and ethnic minorities, and some of those minority groups have significantly different extended families in their household. And so what we're trying to do is adapt to the changing society that represents the United States.
You know, and what's available. I mean, part of you've reached into a subject I wasn't going to ask you about, but you're right on the edge of it. So I can't resist the temptation. But the whole horizon line of financing right now. I mean, as real estate has been moving up, the investors have been pushing it up. There's a point where in my sort of generic version of the real estate market, right? The rise in the real estate market is it's pushed up by investors at the bottom of the market. They raise it up to a particular price point where they can't take it any further. Their return on equity doesn't make sense to them anymore. We then have a few other players that will come in because they accept slightly lower return on equities, larger hedge funds and stuff like that. But then there's a point where you count on the single-family residence market itself to take off, where it really is people who are purchasing it for a home for themselves to live in. It is not investors looking to make a commodity out of it.
Mm-hmm.
And that takeoff is what we've been waiting for, was what I have been waiting for. I don't know about you, and the other $3 trillion of worth of mortgages you have out there, but that takeoff is what I have been watching and looking for. And when I look at Fannie Mae and I look at the core central insurance companies, quote-unquote insurance companies that are out there that support loans, I do go, well, there is a direct effect between what your guys' policy decisions are and what my regional bank is willing to do, because they're not going to portfolio their loans. They're going to look to get insurance on it, and then they're going to look to sell that loan because they're not capable of keeping it. So when you talk about a new program like this where you are analyzing the market and coming up with what you think the consumers need, right, in order to support. Go ahead. You get it.
Sure.
You know what I'm laying out.
There's two or three things to think about there. One is a commercial bank, for example, has to satisfy its regulators by having a diversified portfolio so that all their risks aren't concentrated. And so if you look at the history of commercial banking, the share of their portfolio of loans that they hold, which are single-family mortgages, runs in a very narrow band between 15 to 20% of all of their assets. And it rarely, if ever, goes outside of that band. So if we only relied on that and not the liquidity that was provided by Fannie Mae, Freddie Mac, Ginnie Mae in the secondary market, then the cost of housing credit and the availability of the cost would be higher and availability of mortgage credit would be lower. So that's a first thing to think about. The second thing is that there is a whole other class of lenders, mortgage banking companies is what they go by, that don't have portfolios, so they couldn't hold the loans even if they wanted to. So they're a pretty significant and actually growing part of the lending community. As far as investors, the typical investor in residential real estate is a mom and pop kind of an investor, somebody that maybe bought their first starter home, was ready, expanded their family, bought another home, kept that one, and rented it out. Or they're a local doctor or some professional that's looking to diversify their personal investment portfolio, and they own a half a dozen houses in their community, which they know well. And so that's actually the vast majority. And it can be bigger than that. I mean, it can be individuals who maybe form LLCs and they hold multiples of properties, but are in it for the long run as an investment strategy. It's a much more recent phenomenon that private equity firms and institutional investors have gotten into that business. And in my view, it's because the price declines were so substantial that they recognized they could buy distressed homes at enough of a discount to get the high after-tax rate of returns that they require as an investment firm. And for individual investors, it's often the break point, whether it is a profitable investment for them, depends on their personal marginal tax rate. And they can take a lower rate of return than can some of those institutional investors. So that's why you kind of get the market tiered the way it is. But I will tell you that given the current demographic posture of the United States, the rental business is going to be a good business to be in for a while. And the institutional investors that I speak to, whereas when they first got into it, say 5 years ago, were thinking opportunistically, now are thinking that this is more of a longer run opportunity for them. And they're using technology to lower their costs and become more efficient. And of course, Fannie Mae is in the multifamily space. We're very large in the 50 and above unit rental properties, but we're not very important in that, say 4 to 50. And then we're trying to work on how can we help investors in that space, but so far we're not great at that.